In September 1985, 5 of the world's most powerful economies gathered in secret at the Plaza Hotel in New York. Behind closed doors, they signed a coordinated plan to devalue the US dollar. Not through war, not through crisis, but by design. It wasn't announced with fanfare, there were no public votes, no televised addresses. Yet in the space of 2 years, the dollar fell by more than 50% against the yen. This was not an accident, it was architecture. The goal? Realign a system that was cracking, a world flooded with American capital, trade imbalances growing dangerously wide, and Japan's economy threatening to overtake the West. The dollar, once the anchor of global stability, had become a weapon too heavy to carry. So they dismantled it, piece by piece, quietly, surgically. But here's the paradox. What looked like stabilization was, in fact, a reset. A reset that bailed out the exporters, punished the savers, and pushed a generation of economies into bubbles they would never fully escape. And now, 4 decades later, the same pressures are back. The dollar is once again too strong. Global trade is tilting, and the calls for currency coordination are no longer whispers. They're in communiques, summits, and think tank white papers. A quiet consensus is forming. The system must bend before it breaks. But what system? That's the real question. Because underneath exchange rates and interest spreads lies something deeper, a code. A code that governs who gains, who pays, and who gets to decide when the game is reset. In 1985, they called it the Plaza Accord. In 2026, it won't have a name. But the pattern will be familiar if you know where to look. To understand what happened in 1985 and why it matters now, we need to step back a decade. The year is 1971. President Richard Nixon has just closed the gold window. For the first time, the US dollar is no longer backed by gold. This wasn't just a monetary decision, it was a geopolitical pivot. From that moment on, the dollar became a pure fiat currency. Its value floated freely, determined by markets, confidence, and, more than anything, American power. And power, in that era, was abundant. The U.S. had emerged from World War II as the undisputed industrial and financial hegemon. Its allies, Germany, Japan, the UK, France, had rebuilt their economies under American supervision. The Bretton Woods system, created in 1944, had tied their currencies to the dollar and the dollar to gold. It was stable, hierarchical, and predictable. Until it wasn't. By the 1970s, 2 things had changed. First, U.S. deficits ballooned, driven by war spending in Vietnam and expansive domestic programs. Second, countries like Japan and West Germany became export machines. They accumulated trade surpluses and began to question why they should keep accepting dollars that lost value year after year. A simple imbalance had emerged. The United States consumed, others produced, and the mechanism linking them, the dollar, was growing unstable. In 1973, the system snapped. Currencies were allowed to float. What followed was a decade of chaos. Oil shocks, stagflation, interest rates over 15%. The global economy, once tethered to a gold standard, now drifted on market forces and central bank interventions. And amidst this volatility, a new order began to form. In the early 1980s, the Reagan administration unleashed a mix of tax cuts, deregulation, and military spending. The economy roared, but so did the dollar. Between 1980 and 1985, the US dollar rose nearly 50% in real terms. For American tourists, it was a golden age. For American manufacturers, it was a death sentence. Exports collapsed. The trade deficit exploded. In 1984 alone, the U.S. trade deficit hit $123 billion, at the time an unprecedented figure. And nearly 40% of that gap was with one country, Japan. Japanese automakers, electronics firms, and steel producers were flooding U.S. markets, not because their products were necessarily cheaper, but because the yen was undervalued by design. Japan's Ministry of Finance, backed by the Bank of Japan, had kept the yen weak to protect its exports. It worked too well. By 1985, pressure reached a breaking point. Congress threatened tariffs. Industry groups demanded currency reform. American jobs were disappearing by the thousands, especially in steel and manufacturing hubs across the Midwest. Economically, the U.S. looked strong, but underneath the GDP figures, its industrial base was hollowing out. And so, reluctantly but decisively, the U.S. turned to its allies. On September 22, 1985, finance ministers and central bank governors from the U.S., Japan, West Germany, France, and the United Kingdom met at the Plaza Hotel in Manhattan. The meeting lasted just a few hours, but its consequences would reshape global capital flows for a generation. Their goal was simple: bring the dollar down. But that phrase, bring the dollar down, hides a deeper truth. Because currencies are not just prices, they are instruments of policy. To shift them is to shift power. What the Plaza Accord really signaled was this: the post-Bretton Woods order had become unstable. And rather than let markets decide, governments would intervene, together if necessary. In short, the age of floating currencies was already over. The choreography had begun. Some economists at the time called it a masterstroke of coordination. Others warned that it would unleash uncontrollable forces. In hindsight, both were right. It started as coordination. It ended as distortion. Within weeks of the Plaza Accord, the markets responded. The dollar began to fall, exactly as intended. Between September 1985 and the end of 1987, the US dollar declined by more than 50% against the Japanese yen and the German Deutschmark. For policymakers, it was textbook execution, planned depreciation, no panic, no crash. But this was the surface. Beneath it, something irreversible had started. Japan at the time was the primary target. Its current account surplus had reached 3.5% of GDP, and over one-third of it came from trade with the US. But what American officials saw as manipulation, Japanese officials saw as strategic design. Japan had built its economy on exports. It wasn't just economic, it was existential. So when the yen suddenly appreciated, Japan panicked. A stronger yen meant weaker exports, and weaker exports meant a direct hit to employment, wages, and growth. In response, the Bank of Japan acted fast and aggressively. It slashed interest rates from 5% to 2.5% within 2 years. The Ministry of Finance flooded domestic markets with liquidity. The government pushed banks to lend and corporations to borrow. The result? An explosion of credit. Real estate prices in Tokyo doubled in just 3 years. Stock prices surged 240%. Land near the Imperial Palace was suddenly worth more than the entire state of California. Japanese banks became the largest in the world, not by innovation, but by leverage. What had begun as a currency deal had mutated into an asset bubble. And Japan wasn't alone. Germany, too, faced rising currency pressures. Its exporters, particularly in automotive and engineering, faced price shocks in global markets. But unlike Japan, Germany was more restrained. The Bundesbank kept a tighter lid on credit, wary of its Weimar-era past. Still, the European monetary system began to wobble. Exchange rate management within Europe became more volatile, laying the groundwork for future crises, including the eventual formation of the euro. Meanwhile, in the US, the picture was complicated. The falling dollar helped exporters as intended. Boeing, Caterpillar, and General Motors regained ground in global markets. But imported inflation crept in. Oil became more expensive. Consumer goods from Asia surged in price. And perhaps most quietly, yet most dangerously, foreign capital began to behave differently. With the dollar falling, overseas investors hesitated to hold U.S. assets. To keep attracting capital, the Federal Reserve had to raise rates again. Interest payments on national debt rose. And so began a cycle that would define U.S. fiscal policy for decades. Borrow more to fund more, while managing the fallout of the last intervention. By 1987, the illusion of control began to crack. On October 19th, Black Monday, the Dow Jones fell 22% in a single day. It was the largest one-day drop in history. Though not caused directly by the Plaza Accord, the roots ran close. Misaligned currency valuations, high interest rates, and programmatic trading strategies collided in a perfect storm. And yet, the crisis did not lead to a reversal. quite the opposite. The very next year, in 1987, came the Louvre Accord, a quieter follow-up to Plaza. Its purpose? To halt the dollar's fall. The same countries that had coordinated to weaken the dollar now coordinated to stabilize it. Within 2 years, the system had gone full circle, from excess strength to excess weakness, from euphoria to anxiety. What does that tell us? It tells us the core problem wasn't the dollar's level, it was the system's dependence on manipulation. When exchange rates are no longer left to float but managed to serve domestic goals, every move becomes a trigger. Every action requires another. And with each coordination effort, the gap between markets and fundamentals grows wider. In theory, the Plaza Accord was a currency adjustment. In practice, it was a warning. The global financial system had become so interconnected, so dependent on U.S. monetary dominance, that even a small shift could reverberate into bubbles, busts, and systemic fragility. And yet, the deeper lesson was ignored. No one asked, what happens when manipulation becomes the default? By the early 1990s, Japan's bubble burst. Trillions in wealth vanished. An entire generation of growth was lost. The U.S. entered a new phase of asset-driven cycles, and Europe stumbled toward a monetary union born not of strength, but of mutual economic pressure. The Plaza Accord didn't break the system. It revealed that the system had no stable foundation. Currencies don't move by accident, especially not when 5 of the world's most powerful central banks are pulling the strings. The Plaza Accord worked not through legislation or treaty enforcement, but through signals. Signals backed by liquidity, interest rates, and the coordinated whisper of intent. Here's how it functioned. Step 1. Coordinated messaging. On September 22, 1985, the joint communiqué stated that some further orderly appreciation of the main non-dollar currencies against the US dollar is desirable. It was a short sentence, but it changed global expectations overnight. Traders understood what that meant. It wasn't a suggestion, it was a signal from the source. Step 2. Intervention. Central banks began selling dollars and buying their own currencies on foreign exchange markets. The numbers weren't disclosed in real time, but estimates suggest that over $10 billion in coordinated interventions occurred in just a few weeks. When the Federal Reserve sells dollars and the Bank of Japan buys yen simultaneously, the pressure is enormous. Traders follow. Markets adjust. Step 3. Interest rate divergence. While Japan and Germany held or cut rates, the U.S. maintained relatively high interest levels. The yield differential began to narrow. That removed one of the dollar's main sources of strength. With lower expected returns, holding dollars became less attractive. Capital flows responded accordingly. And then the feedback loop began. As the dollar weakened, export-heavy economies like Japan saw capital inflows. Their currencies appreciated further. Their central banks, attempting to slow this, injected more yen into their systems. But that liquidity didn't just sit in vaults. It moved into real estate, into stocks, into loans. That's the overlooked side of Plaza. It wasn't just a currency play. It was a liquidity chain reaction. Because when a central bank defends its exchange rate by printing more local currency, it injects fuel into domestic markets. And when that liquidity isn't sterilized, meaning when it's not neutralized through bond sales or reserve tightening, it becomes credit. In Japan, sterilization was partial at best. The goal wasn't just currency adjustment, it was growth maintenance. Keep exports competitive, keep domestic demand rising, keep employment stable. So banks were pushed, sometimes unofficially, sometimes explicitly, to lend. They did. Between 1985 and 1990, Japanese bank loans expanded by over 45%. Property prices tripled in urban centers. Corporate valuations detached from fundamentals. But on the surface, it all looked like prosperity. This is how macroeconomic coordination becomes microeconomic distortion. A single currency realignment, agreed upon by 5 finance ministers in a hotel, triggered a decade-long chain reaction that no one fully controlled. What began as exchange rate policy morphed into asset inflation, debt accumulation, and eventually systemic fragility. Meanwhile, in the US, the weakening dollar increased the price of imports. Consumer inflation crept upward. The Federal Reserve, wary of another stagflation episode, kept rates relatively high, which in turn attracted speculative capital. This capital, however, didn't flow into factories. It flowed into financial assets, bonds, stocks, leveraged instruments. Plaza was supposed to fix trade imbalances, but it exported volatility. And what made it possible, what allowed it to work in the first place, was the silent agreement between nations to interfere. Not permanently, not in theory, but just enough to restore balance. Balance, of course, is subjective, because once the precedent was set that global currencies could be realigned through political will and central bank force, the system changed. Market expectations changed. Every trader, every fund manager, every multinational CFO now had to account for invisible hands. The floating exchange rate regime, established after Bretton Woods, never truly floated again. What followed was not free markets. It was managed perception. And perception, once managed, must always be managed. The dollar fell. That part worked. But the price was steep and unevenly paid. By 1987, the Japanese yen had soared from 240 to 120 against the dollar. On paper, it was a success. The U.S. trade deficit began to shrink, Japanese exports slowed, and pressure on American industry temporarily eased. But beneath the statistics, a silent fracture opened. In Japan, the aftershocks of Plaza were immediate and far-reaching. With their export edge eroded by a stronger yen, Japanese policymakers pivoted. They would stimulate domestic demand at any cost. The Bank of Japan kept interest rates low. Fiscal policy became expansionary. Credit, already abundant, became overwhelming. Land prices in Tokyo's commercial districts rose by 300% between 1985 and 1990. Households borrowed against future income. Corporations borrowed against future growth. The Nikkei index soared to 39,000, powered not by productivity, but by speculation. Banks lent freely, often without collateral, to real estate developers and industrial giants who reinvested in each other. A closed loop of leverage. The result was not a business cycle. It was a financial supernova. By 1991, the bubble burst. Land prices collapsed. The Nikkei lost more than half its value in 2 years. Banks were left holding trillions of yen in non-performing loans. But the full collapse was not immediate. It dragged on, year after year, like a controlled demolition in slow motion. What followed became known as the Lost Decade, a period in which Japan, the second largest economy in the world, grew at barely 1% per year. Asset prices never recovered. Consumers became permanently cautious. Corporate debt deflation set in. And through it all, the Bank of Japan kept interest rates near zero, long before zero lower bound became standard language elsewhere. The cost? A generation of lost momentum. And it started with a decision made in a hotel suite in New York. Germany faced different but no less significant consequences. The Deutschmark appreciated, as planned. But this made West German exports less competitive just as the country approached reunification. The economic integration of East Germany, structurally weaker, socially unstable, required massive public spending. But with tight monetary policy and a strong currency, Germany found itself squeezed between fiscal necessity and monetary discipline. To absorb the shock, Germany leaned harder into European integration. The groundwork for the euro was laid. Not just as a political project, but as a response to Plaza-era currency instability. European leaders concluded that the only way to shield themselves from the dollar's volatility and from each other was a common currency. But the convergence criteria masked deep imbalances, which would later explode during the Eurozone debt crisis. And what about the United States? The trade deficit narrowed, briefly, but the core vulnerabilities remained. U.S. manufacturers didn't reindustrialize. Instead, companies shifted further into financialization. As the dollar weakened, capital turned inward, toward asset markets. The late 1980s saw the rise of leveraged buyouts, junk bonds, and speculative mergers. Wall Street boomed. Main Street stagnated. By the 1990s, the dollar was no longer strong, but American finance was. The system had adapted, not through export growth, but through debt-fueled consumption and capital gains. And the debt stayed. Public debt rose from $1.5 trillion in 1985 to over $3 trillion by 1990. Private debt, too, expanded. Credit became the new engine of growth. Each recession was met with lower rates, each recovery with more borrowing. The global system had been altered. Currencies were no longer prices, they were tools. Central banks, once reactive institutions, became proactive players. Market participants began to anticipate intervention and price it in. Speculation increased. Volatility became endogenous. The idea that major currencies should reflect fundamentals, productivity, trade balances, fiscal discipline, faded. In its place, liquidity cycles, coordinated signals, and moral hazard on a global scale, and no mechanism to unwind it. The Plaza Accord was not a solution. It was a substitution. One crisis, trade imbalance, was traded for another: asset inflation, debt dependency, and structural fragility. The system no longer broke. It bent. Permanently. And today, we live in its echo. Because when the cost of stability is control, that control must never stop. Now fast forward, 4 decades later. The world is different, but the code remains the same. In 1985, the dollar was too strong because of trade imbalances. In 2025, it's too strong because of capital flows. Back then, it was Japanese cars flooding U.S. markets. Today, it's American assets pulling in foreign capital, again. But the mechanics, they've evolved. Let's start with the symptom, the dollar. Since the COVID shock in 2020, the dollar has regained dominance, not just as a currency, but as a global safe haven. The U.S. economy rebounded faster than peers. Interest rates rose earlier and higher. Capital fled emerging markets and poured into U.S. treasuries, tech equities, and the vast labyrinth of dollar-denominated debt. Between 2021 and 2024, the dollar appreciated more than 25% against the basket of major currencies. The Japanese yen fell below 150. The euro briefly dipped under parity. Currencies in South Korea, Taiwan, and Southeast Asia weakened sharply. The story repeated. America absorbs, others adjust. And just like in 1985, tensions rose. Exporters suffered. Inflation soared in import-dependent economies. Emerging markets struggled to service their dollar debt. Capital flight reemerged as a systemic threat. Central banks in Asia and Latin America intervened, burning reserves to defend their currencies, a familiar ritual from past crises. But here's what changed. Unlike 1985, today's global financial system is more entangled and more fragile. Back then, trade imbalances dominated the conversation. Now, it's capital imbalances. Trillions of dollars move instantly, not because of goods crossing borders, but because of algorithmic strategies, interest rate differentials, and central bank forward guidance. This is not trade-driven dollar strength. It's portfolio-driven, and that makes it harder to contain. In the past 3 years, policymakers have begun quietly signaling something striking: the need for currency realignment, exchange rate consultation, and monetary policy coordination. These phrases appeared in G20 statements, IMF briefings, and even internal memos at major central banks. The code is back. But this time, the stakes are higher. Because unlike 1985, there is no clean balance sheet left. Japan's interest rates are still near zero, but its debt to GDP ratio is over 260%. The European Central Bank is trapped between inflation and recession. China, which wasn't even part of the Plaza Accord, now holds over $3 trillion in reserves. yet faces capital outflow pressure of its own. And the United States? Its national debt crossed $34 trillion. Its fiscal deficit exceeds 7% of GDP in peacetime. And still, the dollar rises. Why? Because the rest of the world is worse. And this is the paradox. The dollar is no longer strong because of strength. It's strong because there is no alternative. And just like in the 1980s, the consequences are compounding. Asian exporters are suffering. Capital is pooling in U.S. markets, creating asset concentration. Multinational firms are struggling with currency volatility. And once again, calls are emerging, softly, diplomatically, for a new kind of agreement. But this time there is no Plaza Hotel. The coordination, if it comes, will not be public. It will be algorithmic, indirect, and continuous. Central banks will not pose together for photos. They will adjust quietly through rate guidance, swap lines, and unexpected interventions. And we've already seen it begin. In mid-2024, the Bank of Japan, the People's Bank of China, and the European Central Bank all began coordinated interventions to weaken the dollar. Not officially, but effectively. Bond purchases, currency swaps, reserve reallocations. The timing was too aligned to be coincidental. Some analysts called it a coincidence. Others, a digital Plaza Accord. The truth is more subtle. It's not about one agreement. It's about the return of the logic. The logic that says, when imbalances grow too large, they must be reset. Not by markets, but by design. And design always carries a cost. In Japan, the cost is imported inflation. In Europe, it's stagnation. In emerging markets, it's vulnerability. In the US, it's illusion. The illusion that the dollar can rise forever without consequence. But the system is creaking. When the world's reserve currency rises without limit, something else breaks. Trade, debt service, global liquidity. The pressure must go somewhere. And as in 1985, the question is not if the system will adjust, but how and who will absorb the cost. Then it was Japan's lost decade. Today, it could be something larger, because in 1985, we reset the system through coordination. In 2026, the risk is that the system resets itself, chaotically. And when that happens, the real surprise will not be that it came, but that the signs were there all along. In 1985, 5 men walked into the Plaza Hotel to correct a currency. They walked out having reshaped the world economy. What began as a gesture of alignment became a blueprint, a quiet doctrine that power could be managed through price, and price through consensus. But consensus never lasts, and price, once manipulated, becomes memory. Today, the same imbalance has returned. The dollar rises not because it is wanted, but because it is needed, because risk is everywhere else. And like gravity, that need pulls the global system toward another silent reset. There may be no signatures this time, no photographs, no communiqué, but the moves are already in motion. The lesson from 1985 was not that the dollar can be controlled, but that the attempt to control it rewrites everything else: debt, growth, trust. The architecture of the next crisis is often built with the tools of the last one. History doesn't repeat, it waits. And when we think we've mastered it, it moves again. If you've made it this far, you're not just watching, you're decoding. This is the history they archived, not the one they teach. Subscribe if you want more stories that connect power, money, and the truths hiding in plain sight. And tell me in the comments, what part of this made you stop and think?